Hello friends, welcome back. We're starting with a new series on principles of finance, and today's topic is inflation. So let's begin. Let us first understand what is the meaning of inflation. As you can see, it says general increase in prices and fall in the purchasing power of money. So to understand inflation, let's first understand what is the meaning of purchasing power of money. So if we were to take example of chocolates, let's understand the purchasing power of money with chocolates example. So if we were to take example of rupee, that is currency here in India. So let's say for 100 rupees, I could buy 10 chocolates. For 100 rupees, I could buy 10 chocolates in 2020. 2 years later, today, if I were to spend same 100 rupees for chocolates, same chocolates, I would be able to purchase only 8 of them. Which means if I have to measure the purchasing power of money in terms of chocolates, in 2020, the purchasing power of money was 10 chocolates. Same amount of money. Now the same amount of money can buy only 8 chocolates, which means in 2022, the purchasing power of money has gone down, has fallen to 8 chocolates. Now the same thing applies to dollars. Let's say for $1, I could buy 10 chocolates in 2020. Today, I'd be able to buy only 8 chocolates for $1, which means the purchasing power of dollar has fallen. So this is the meaning of purchasing power of money. And inflation means two things happen. First, general increase in prices. That is, the prices of all the commodities and services will increase, all goods and services. We are taking example of chocolates. So similar to chocolates, all goods and services, whether they are food items or clothing or vehicles, the petrol prices, fuels, everything, all the prices will increase, and at the same time, now prices increase, which means for the same amount of chocolates, for the same number of chocolates, or for the same goods and services, now you have to pay more money, which means purchasing power of money falls. So this is the meaning of inflation. Now, you all must have heard this term very often whenever people talk about inflation. This money supply has some connection with inflation. Now, what is that? So let's first understand what is the meaning of money supply. It says total volume of currency held by the public at a particular point in time. Total volume of currency held by the public at a particular point of time. Now there are various measures of measuring money supply. You all must have heard about M1, M2 and the formulas M1, M2, M3, M4. So we'll need a separate video to understand those formulas, and we'll discuss it at length in some other video. But as of now, just for the purpose of this video, let's understand. Money supply means the total currency in circulation. Now this includes cash as well as bank deposits. So let's say if I have $100 in my wallet, plus I have $10,000 in my savings bank account. So for the purpose of computing money supply, the cash as well as the bank deposits would be considered, because having money in the bank account is as good as having cash. I can spend it just like I spend my cash or hard cash. So money supply is the total money in circulation in the economy, total money with the people of the economy. Now, how is money supply related to inflation? And why are people saying nowadays, almost in all the news channels, you all must have come across that people across the globe are protesting against the government, against the ruling party, saying that the cost of living has increased, there's inflation in the economy, government isn't taking enough measures to control money supply. So what is all this about? How is money supply affecting? So as I said, money supply is the total currency in circulation, means total money with us, the people of the country. So money supply, if the money supply increases, what does this mean? This means money with the public or the people in the country increases. Now when you have more money, what is the obvious reaction of the economy? People will tend to spend more. So when, let's say, if my salary was, let's say, $1,000 per month, if this salary increases to, let's say, $1,500 per month, what would be my immediate reaction? I would spend more. So what happens is, when the money supply or money with the people increases, automatically the demand for all goods and services will increase. I will, let's say, watch more movies. I would want my kids to study in better schools and colleges. I would spend more on clothing. So demand for all goods and services will increase. But what happens to supply? What happens to supply? Now, supply of goods and services is something which cannot be increased immediately. At least not all goods and services. Like we took example of schools and colleges. So if, let's say, in general the money supply increases and the parents say that we want the best business schools for our kids. Now, business schools is not something that, okay, the demand increase, let's start some new business schools. That doesn't happen. So the supply will take some time to adjust to the demand. So meanwhile, the supply is still constant or it is increasing but not in proportion to the demand. In that case, what happens? Now, all of us have studied this in law of demand. What does law of demand, law of supply say? This is a general demand curve. Let's say this is a demand curve and this is your supply curve. How does the market function? Quantity supplied, quantity demanded. So the place where the demand and supply meet will be the price. Now, this OP is the price. Now, suddenly, if the demand increases, yes, first Q quantity was demanded. Now, suddenly the demand has increased to Q2. Now, increase in demand, but supply cannot be increased immediately. Supply takes some time to adjust to the demand. So, in the meantime, what will happen? Supply is constant, demand has increased. This will result in the prices to go up. You can see P1 and this is P2. The price has gone up. Same thing happens to all the goods and services. Suddenly, because of the increase in money supply, people start demanding more. And in order to meet this demand, the supply is still trying to catch up. So meanwhile, what happens? The prices of the goods and services increase. The prices of the goods and services increase. General increase in prices. Which means what happens is, now everybody wants a seat in the business school. So let's say if the fees was somewhere around, let's say $30,000 for a particular course for 100 seats, and on an average every year some 150 students used to apply, out of which 100 students were selected. Now suddenly if the demand for these business school seat increases to, let's say, 1,000 applications a year, what would happen? If the supply is limited and the demand is huge, the prices will go up. So the prices will increase. Probably the same institutes will start charging more for the same courses. Yes, if the supply of chocolates cannot be increased in the short term, what will happen? Shortage of supply means the chocolates will become expensive. So this will result in rise or increase in the prices, which means the purchasing power of money has fallen. So this is the connection with money supply. So when money supply increases, and if it is not controlled, what will happen? The demand will go on rising and supply will take some time to catch up. It cannot be increased immediately, as a result of which the prices of all the goods and services will shoot up, leading to inflation. Now, what is the problem? Even if the prices rise, people are ready to pay. Yes, if people are ready to take admission in the institutes at this price also, if people are ready to buy whatever commodity we are talking about, they're ready to buy cars, they're ready to buy petrol, they're ready to buy clothes at this price, this new price, if they're ready to pay, then what is the problem? Why are people complaining about inflation? The reason is, at some point of time, this excess money will be spent. And the increase in the prices, if this continues, now what happens was, my budget of $1,000 a month now has increased to $1,500 and I started spending more. But at the same time, the prices of the commodities or the goods or the services that I used to purchase has also increased. So the essential commodities like food, clothing, shelter, health, education, all of these will become more expensive. So the things which I used to buy for $1,000, now I won't be able to buy the same commodities even at $1,500. Why? Because things are becoming expensive, and this is where the problem arises. So inflation, if not controlled in time, what will happen? Even the basic essentials, I won't be able to afford the basic essentials like food, clothing, shelter, health, education. And this is the reason we see so many protests across the globe. So what is the solution? You all must have heard many people debating on the news channels that the government should have some strict monetary policies, they should decrease the interest rates, they should have some money supply control policies in place. So what are these? What are the measures to control money supply? Well, this is again a detailed topic which we'll be covering in the next video. In this, we have one more topic to be covered: inflation and its types. Now, inflation is of two types: demand pull inflation and cost push inflation. Now, the examples that we took of chocolates or the business school seats was demand pull inflation. The prices of this, the cost was $30,000. It was increased to $50,000 per course. Now, why did this happen? Because the demand increased. So prices were somewhere here, $30,000 per course, and the demand went up. It pulled up the prices. So it's demand pull inflation. There's one more type of inflation. It's called cost push inflation. Now currently we are halfway through the year 2022 and almost the whole world is facing fuel crisis. Now shortage of fuel means the prices of fuel will shoot up. Now fuel is expensive. When fuel is expensive, transport cost increases, manufacturing cost increases, which means cost of production increases. Cost of production increases. Now see, if demand increases, now in this diagram we saw this was demand, this was supply, and here the two curves meet. OP was the price. Suddenly if there is an increase in demand, the price rises. Okay, understood. Now this was because of demand. But if the cost of production rises, what if the cost of production rises? Now, let's say because of the fuel prices, the transport cost, so some commodity which was probably the cost of producing that commodity was $100, which was sold at a final market price of, let's say, $150. Now, if the transport cost increases by, let's say, $5 and the production cost increases by another $7, what will happen? The cost of production increases. Now the manufacturer, the producers, the distributors, the retailers, these people are not going to give up their profit. This margin of $50, they will maintain their margin or maybe increase their margin. They're not going to give up the margin because even they have to face this. Even since the prices of all the goods and services have increased, they cannot reduce their own income or profits. So in order to maintain this profit or even increase it further, what will they do? They will increase the selling price. So which means a commodity which was available, let's say at a market price of $150 will now become more expensive. Now this rise in price is not because of demand. Not because the demand increased. What happened? The cost was $100 and because of the cost of production, the cost was $100, market price was $150, the cost of production increased, it pushed the price up. Cost push inflation. So these are two types of inflation: demand pull and cost push. I hope these concepts are clear and thank you for watching. Happy learning.